Recording has started.
Okay, we're going to call to order the retirement board meeting, and we are going to look for a motion to approve the minutes from July 16th. Is there a motion to approve those minutes?
Motion to approve minutes.
Second.
Been moved and seconded. Any final discussion on the minutes? Hearing none, all in favor say aye. Aye?
Aye.
Motion is carried. Okay. So again, the sincerest apologies for the delay, and we appreciate both of you gentlemen taking the time to update us on our performance during the second quarter, and we'll turn it over to you all, and we look forward to your presentation. Again, I don't have any hard stop. I'm good until 12:30. I don't know about Jason or Mark, but are we all good until 12:30 if we need to go until then?
Yeah, 12:30 works for me.
Okay, and we should ask the gentleman from CS McKee. Is that okay with you?
Yeah, that's fine. Yeah, that'll be plenty of time. We should be able to get you hopefully ahead of schedule.
Okay, thanks, guys. Appreciate it. All right, we'll turn it over to you.
Okay, great. Thank you. Well, it's amazing, right? In the world of COVID and technology, here we are. People are spread all over the place, and we're having a meeting almost like we were sitting in the same room. So you got to love the fact that technology works. 10 years ago, we couldn't have done this. So this is impressive. I have with me again Bob McGee. I think you remember Bob McGee from last quarter. He's one of our equity portfolio managers. Actually, Bob is the senior most member of the team. He joined the team in 2000, but he wants me to make sure I say he's not the oldest member of the team. So there's a difference between being the most tenured and the oldest. Hopefully everyone's got a copy of the second quarter performance report that I sent out in front of them. What I thought I'd do for today's agenda, Bob is going to review the domestic and international portfolios. I'm going to go over the fixed income portfolio. And then we want to talk to you about some thoughts we have about your portfolio, given the recent announcement by Chairman Powell of the Federal Reserve, and what that means for fundamental management going forward. So we have some thoughts that we want to share with you then. But overall, the second quarter was not bad, both in absolute and relative terms. Portfolio returned 12.19% versus 11.41 for the blended benchmark. Year to date is still trailing by about 3.8%. But happy with the bounce back, certainly in the second quarter, at least a little bit there. So with that, Bob, do you want to start with the large core and international portfolios, and I'll come back and do fixed income?
That'd be great. Really just starting of the you look at the large cap and the international. Obviously, the markets are a lot better than they were from the the end of March. The S&P's up over 20%. On the large cap equity piece, our piece is up, just trailing that of 20.1. We were a little bit behind the benchmark for the quarter. And then the international piece was up 12.9 versus 14.9 for the quarter. It was a very interesting quarter. It continues to be, I guess, about whether we're going to recover, what's going to happen. We're still down on the year, but after the big declines we saw in the first quarter, it really did see a nice rebound. I think that if you look at top contributors to our portfolio, and is Apple, Microsoft, Facebook, and Alphabet were our best performing stocks. In there as well as Dick's Sporting Goods was a nice recovery as the market has really seen that we're not going into a recession. We really are going to come out of this. There's a lot of moving parts. The difficulty in the market really is the restaurant space. Specific retailers have worked. I think that the Dick's story is that team sports was a big negative in the first part of the year. People were concerned what was going to happen there. But what they found is that individual sports, it's very difficult to buy a bike these days. So they've benefited from that, and a lot of people are going running. So that's some areas that I think have rebounded. I think that that's kind of one of the things you see across the market, is that there are select areas that are working and others that aren't. You know, our biggest concern really going into the market is that you know, if you look at our two biggest holdings in the portfolio today, Microsoft is 9.6% of the benchmark, and Apple is 8.7. Those are not big overweights. It's a case of, you know, the bigger names and the bigger market cap have really driven the market this year. You know, and it's continued. You know, there's been some areas where you've seen a little bit of a recovery play. We do have some stocks, a small percentage in, you know, in Delta Airlines and Marriott. You know, really kind of some stocks that will benefit from a vaccine if we get one. We think that they're still making some inroads to that. I think that that's, you know, kind of the healthcare sector will, you know, continue to be important. But what we're looking at really is the biggest concern that we're having is really that how big the market has gotten in some of the, as a percentage of names in the top, you know, 6 names are you know, somewhere close to 30% of the market cap. So those, you know, there's we don't own Amazon because the valuations are too high. It's been very difficult for us in this environment to, you know, we really start with a fundamental valuation, but it becomes it really has become an issue where the market is looking for short-term growth, irregardless of what the valuations are. We have, you know, always been disciplined in fundamental valuation. We think that there's, you know, still is opportunity. We're not sure how quickly that will return. And you know, Rob and I will address an alternative to that here in a little bit. But you know, overall, we still see, you know, the valuations of the market. You know, you look at our portfolio is 18 times earnings versus the you know, the S&P at 19 times, with our projected growth rate being higher. So when you look at the market, you know, it's based on where interest rates are, I think it's a very attractive market, you know, a fair value market. I think there's a number of individual stocks underlying the market that look good. Our difficulty really has been, you know, finding those names that are going to outperform, and I think some of that is given where, you know, where we've seen the market go. I think there's we've seen a lot of indexing going, so it's kind of that money stays in there. So it's where does momentum investing has become more of a theme. You know, when that changes, we don't know for sure. You know, from a sector standpoint, you know, we still have a big overweight in industrials and technology. We think that there's some productivity things that have happened. You know, our sector weights have really paid off for us. But it really is, you know, overall, we're continually watching this. We had the nice rebound off the bottom. So we think the GDP in the U.S. continues to come off of that. You know, some of the earnings calls that I've been listening to, you know, the June order period for industrials has gone up. You know, April and May were very, very slow, but June is rebounding very, very nicely. You know, I think that's one of the big concerns also is what happens if the, you know, extra stimulus paycheck protection goes away. You know, obviously restaurants are continue to be a concern, but we're really looking at, you know, when we look at it, we're still seeing some spending elsewhere. We think, you know, Starbucks is a position we think that will do well. People still want to go out. It's just a way, you know, how can they continue to manage that? You know, and you know, the big key is, you know, there's a couple ways out of this. I think that one is that, you know, although cases are going up and from an investment standpoint, you know, a vaccine will work. You know, people are becoming more educated on wearing masks. There's you know, there's a point where, you know, we will get that that when we get to a certain point, the people will have some immunity to it. I think that will help. Testing is obviously going up, which is, I think, the biggest contribution to, the high positive rates. And, the treatment is getting better as well. So I think those all bode well for, the equity market's probably going to kind of be moving sideways here. But there's still some opportunity. From the international perspective, we still have, we have an underweight overall in the international. We still see the U.S. market as being a slightly better place to be. But our big underweight there is really it's to England, to the UK. We think that there's with the Brexit, there's still a lot of concerns there. But they've done a better job of managing the coronavirus, at least on the number side. But overall, we're still positive that a lot of the international markets will come back. And with that, just really kind of getting to the big picture, we ended the quarter with a slight overweight into the fixed income. So we've made a number of good decisions to, pull back on the equity positions over the last 6 months. We did increase it back in March, and then, took a little bit of that off the table in June. But currently, we're right on that, very, very close to that, the 55% equity, 45% target that, that we is kind of the midpoint of the allocation call. And with that, I'll take any questions from the equity side or turn it over to Rob for the fixed income.
Okay, thanks, Bob. Any questions at this point about Bob's presentation? Okay, Rob, the floor would be yours then. Rob, are you able to hear us? We may have.
Okay.
Is Rob? I can't see Rob by chance. Did he fall off maybe, or?
Yeah, I don't see him either. So
Okay.
I'll just go ahead and start, and he'll pick it up when we get here. How's that? From the fixed income side, the first part of the year was credit quality was an issue. As we saw the big decline, corporate bonds sold off. That has picked up and gotten better here this quarter. The fixed income market did, we were up 3.6% versus 2.1 for the market. Overall, we're still have a big underweight to treasuries. We think that the corporate bond market is a very good place to be. From a outlook perspective, we still continue to expect interest rates to remain low. The Fed governor has come out and said that he expects to keep them very, very low for the foreseeable future. That's one of the things that, to take advantage of that in the fixed income side. We did add to our, TIPS position. We're looking at, inflation to be, a little bit more of a concern going forward. And, that's something that we think that you can invest in. So
Can you guys see me? Can you see me?
yeah, now we can hear you, Rob.
Yeah.
Yeah, so I was able to see you guys. I was talking and everything, and I had this network resolving problem spinning around couldn't tell. You couldn't. Oh,
This
And
is
he
what,
dropped back.
stay. So,
Rob.
no?
It-
Can you hear me now? No?
Now it's a little bit better. It is better there.
What's going on?
I'm not sure. If you wanted to, oh, there we go. It actually is a lot better right now. If you wanted to, Rob, you can always use the phone number to call in, and that might be the best way to do it if you're having data or Wi-Fi issues. You could just you could call in. That might be a way to do it.
Can you hear me? I don't know how long this is going to stay because I keep getting this. I keep getting kicked out here. I don't know what's going on.
You're pretty clear now,
Can you see
Rob.
me?
Yeah, we can see you, and you were pretty clear. If you want to, and I did a little bit of the fixed income review.
Okay.
So if you want to talk about the,
Okay.
why don't we start there? If you can, if that works.
Sure. Okay. Well, you know, I apologize. They freaked me out a couple of times. Hopefully, the
Rob, that's not
stay
working.
here for a little bit. But Bob, thank you. So a little bit.
Okay, he's off.
Well, let me see here. So Rob, are you able to see? Are you able to see the chat message that you just received?
No.
There's a chat message that has a phone number there, the meeting ID, and if you put in your participant passcode, you'll be able to call in. We haven't had any issues if people call in. It may just be a connectivity issue from your end.
I can't seem to stay connected for more than about 2 or 3 minutes at most, and then it kicks me back out again.
Not a worry, Rob. If you wanted to call in, that'll probably give you the most secure connection, and we put that in your chat box there. I don't know if you can see it or not.
I'll try that.
Okay. Yeah. We'll. Sure.
All right, hold on. Do I have to get out and then call back in?
Yeah, that works fine. If you wanted to exit the Blue Jeans meeting and then just call in, that'd be great. Thank you.
Okay.
Okay.
Are there any questions on the fixed income side while we're going over this?
Well, I think from the benchmark standpoint, fixed income has always been your bread and butter. It's really been we're really happy to see how much of a how well you've done there. And there was a little bit of a tease up front about in light of some of the changes that have happened with the Fed, you may have some comments related to that, if I heard correctly.
You did, and that's what Rob's gonna when we come back in here, and I'll just get it started. And one of the things that historically what we've done is we've done very well on the fixed income side. Previously, for the last 5 years, has been a struggle on the active equity side, and we've come up with a solution to really look around the individual stock risk that we've had difficulty with. And the other part of it is we've done a really good job of doing the asset allocation part of it, where we go in and actively decide whether we should overweight equity, what parts of equity.
Can you hear me now? Hello?
Yes, now we can hear you, Rob. And Rob,
Okay.
I'm starting going over that where I'm at, and please continue this part of it. But just really that the fixed income has done well, and the active allocation has gone well. But I'll let Rob jump in here. But we've come up with a solution where rather than doing the international stock selection and the the large cap core selection, we have a solution now that we're starting on, and we have several clients that are looking at it, and some are starting to invest, where rather we would buy active ETFs, passive ETFs for various markets, and make a decision between growth value decision and a small portion of it. Start with the the S&P would be the core component, and then we'd have two international components that we would go with it, and have a small limitation to overweight some sectors at time. So currently we would have a slight overweight up to 5% of the portfolio, but currently we'd have a 1 or 2% overweight in technology, and like a 1% overweight in industrials. But that's that's kind of the scheme of it. And Rob, do you want to jump in with that?
Yeah. So just by way of background, what's driving some of this recommendation is on June 10th, the Fed Chairman, Jerome Powell, announced that the Fed plans on keeping interest rates near zero through 2022. So that's another 2.5 years of looking at roughly 0% interest rates. In fact, his quote was, "We're not even thinking about raising rates." And this low interest rate environment has been a very difficult place for equity managers who are focused on fundamentals, like McKee, to add value. And a lot of fundamental managers have struggled here, and we were no exception to that. And you guys have seen that. And given that it looks like interest rates are going to remain this low for the next 2.5 years, we're talking to some of our balanced account clients about this indexed asset allocation approach using ETFs for equities, but still using our actively managed fixed income, which actually ranked about 6th out of 161 managers over the last 10 years. So as Bob alluded to, it's a function of taking an asset allocation approach, which historically has added value for us. It's really been in this environment for fundamental managers that has been a pretty strong headwind. So if we see this low rate environment persisting for another 2.5 years, rather than change what we philosophically believe is the right way to manage equity portfolios, meaning buying stocks that are trading at a lower valuation in the market and growing faster than the market, and chasing momentum or something. If we think that this looks more like, let's say, 1996 than it does 1999 or 2000, then that means there's another couple of years in this low rate environment that the index should outperform most active managers. And the reality is, for the last 5 years, 81% of large cap core managers have underperformed the S&P 500 index for that 5-year period. So rather than fight it, we think it makes more sense to go with it. And when we see that environment changing and we think it makes time to go back to active, we'll come back to you and say, we think it's time to make the switch back. But, ride the wind while the wind is blowing, and then when that changes, tack to a different course. So that's kind of the recommendation. We see some advantage to that. One, obviously, it removes the headwind for fundamental active managers. It allows us to continue to add value through our asset allocation decisions. And, it will lower your fee fairly meaningfully, somewhere between $20,000 and $30,000 less in terms of your overall fee by doing this. And then it gives us the flexibility to, monitor the environment. If the Fed changes course, we can change course. So we think it might be better for the overall portfolio performance to consider. So, we're throwing that out, and a couple of clients have already decided they're going to go down those roads. Any questions, any thoughts about the approach?
No, thank you for the context and the thoughts around that. Any feedback initially? I think we're always open to seeing how we could structure things differently. My 2 cents would be that putting a proposal together, putting some more context onto that would be helpful.
Yep.
And we could certainly review it. But one of the challenges is we have three of the members of the retirement board here today. We obviously want to get feedback from our other commissioner and our treasurer related to this, but that would be a good way to kickstart the conversation to see what kind of options are out there.
Sure, absolutely. I'll put together a pretty comprehensive deck that explains the logic behind it and what we see as the advantage to it. And then, certainly we're happy to sit down with you guys again and talk about it and see if you have any questions and go through it.
Okay, and if you're able to let us know those other counties that have gone in that direction, that would be helpful as well. We always like to be able to reach out to our counterparts in those counties to see what their thinking was, and if you're able to do that, that'd be helpful.
Sure, absolutely. Glad to do that.
Excellent. Any feedback, Commissioner Higgins, Controller Moser?
No, that sounds good. And I was going to ask the same question about if we'd be able to get a couple of the other counties that were maybe going that route, just to get their thoughts and feelings too. So, my proposal would be good.
Good.
Yeah,
Absolutely.
Anything that's going to give similar performance with lower fees is always good news.
Yeah, well, hopefully, in relative terms, better performance in this environment, this low rate environment. And Bob, do you want to just take a minute and talk about, what the impact of that low rate environment is and why it represents that headwind?
Yeah, and that's one of the things that, on the active side, and it's very, very difficult for me because that's what I do for a living, but it's, is find stocks. But what we found is as I mentioned earlier, that in this low rate environment, the ability to separate companies from the market perspective gets much difficult because those that do a bad job, they borrow money and there's not really much cost to it. And they can continue to service that debt and everything's fine. And then you have on the other extreme, everything is really then becomes macro driven. So a lot of times everybody succeeds at the same time. So it really has become harder to separate the winners and the losers. The other part of that is that I think there's still that theme of, the technology growth is still there. If I find a company that continues to grow, it doesn't matter how much you pay for it. And I think that's, in this current environment is what we're up against. And I think that's, historically when rates are low, it's very, very difficult for active managers to add value. And that's the environment we're in. I think that's the environment we're going to stay in for the next couple of years. I still think that, long-term active management works, but it's a case of it's become more lumpy where you're going to have more extremes to add value, but you're also going to have more extremes where, you underperform. And that's the environment that we really see for the next, 5 to 7 years. And that's really why, we wanted to reach out to our clients with this alternative.
Okay. Well, thank you. We appreciate the context. We appreciate the heads up, and we'd be happy to review this in the coming days. We hold internally as a retirement board meetings where we discuss amongst ourselves, just our thoughts on different things and different reports, etc. And so we would be able to discuss that at that forum and provide some feedback back to you. But we appreciate that very much. Thank you for continuing to look at the landscape and provide us feedback on how we can move forward in a positive way. So we appreciate that.
Absolutely, that's part of our job. So I will have something put together for you, and you should get it sometime next week. And certainly after reviewing it, chatting about it, if you have any questions, please don't hesitate to reach out, and we can go into as much detail as you would like.
Excellent. Okay, super. Any other questions, comments for partners at CS McKee? And if not, we can discuss anything else. Jason, we don't see anything else on the agenda here. Has anything else come up that we need to be aware of?
No, not at this time.
Okay. All right. Hearing no other questions, comments. Again, we sincerely appreciate the patience to Rob and Bob as we collected ourselves here today. And we look forward to getting that proposal in the days and weeks to come. And we'll be back in touch. Again, thank you both. We hope you and yourself and your families and everyone you love and your friends are safe during this difficult time. And we wish you the best time that you can have during these difficult circumstances. And we wish you well.
Absolutely. Thank you very much. Same to all of you. We will get to the other side of this, and it'll be something that we'll remember certainly for the rest of our lives. But appreciate those thoughts. Wish you all well. And looks like we managed to get done ahead of the 12:30 deadline, so you guys have an extra 8 minutes.
Sounds good. All right. Well, we would then look for a motion to adjourn then at 11:22. I'm sorry, 12:22.
Motion to adjourn at 12:22.
Second.
All in favor? All in favor, say aye. Aye.
Aye.
Aye.
All right. Thank you, everybody. Have a great day.
Thanks, guys.
You too.
Thank
Take
you.
care. So long.